Hi guys, a very good afternoon and welcome to Mutual Fund Corner. I'm Pavitra Parekh. With me is Sonal Bhutra, and today we're going to do a deep dive and get you a complete explainer on dividend yield funds. The portfolio of such a fund is one that basically just comprises of stocks that have a consistent track record of paying dividend to their shareholders. So what is the potential here? What is the case for investing in such a fund? And why should you pick it over another equity category, right? So we'll answer all of these in our very special chat. We have the team at SBI Mutual Fund with us.
Oh, yes, very important guest that we have on our show today. So let's welcome DP Singh, the Deputy Managing Director and Chief Business Officer at SBI Mutual Fund, and Rohit Shimpi, the Fund Manager at SBI Dividend Yield Fund, to discuss all about dividend yield funds. Gentlemen, good afternoon. Thank you so much for joining us here on CNBC TV18. Glad to have you on the show as well. Mr. Singh, let me come to you first up. I want to understand how successful has the dividend yield strategy been worldwide, right? And what is the opportunity in India itself now that we are seeing some growth come back?
Yeah. Thank you very much, first of all, for having us here. Thanks a lot. As far as dividend yield fund is concerned, we did a lot of research on it. It's not something new which has come into the market. But of late, the corporate sector in India is actually giving good dividends, as well as we have seen when Rohit and his team did the deep dive into this category. We saw there are quite good number of companies which are giving a very handsome dividend, as well as there are companies which are having very good growth potential, mostly value companies. And against the general perception that dividend yield companies are mostly into the what you call in the large cap category or the public sector space, we saw there are a lot of companies in the mid cap and small cap also, and now the businesses are doing so well. They are giving very handsome dividends. So we thought this is the time when there are some uncertainties in the market, and this when we did the back testing, we saw that generally on the downturn of the market, these give very good and safe returns to the investors. The downward journey is much less swifter than the other stocks. So controlling the downward territory, as well as giving a regular kind of cash flows to the investors through SWP route, that's what we thought will be a good strategy. That's why we came out with this as a solution to the clients.
All right, that point is taken. Mr. Singh, but you know, a lot of these stocks which typically pay dividend are the large cap stocks, or they are the PSU stocks, right? What do you see as the main reason that someone would invest in a dividend yield fund over, say, just a regular large cap scheme or a PSU focused fund?
Yeah, there are two parts of it which I will take it. First thing, that perception is not right. The PSUs and large cap are only 15%. If we look at the PSUs is only 15%, and remaining is non-PSU. And when we compare with the Nifty dividend yield index, the companies are much more which are beyond this index, and where there's a good growth potential. And it's not going to be large cap kind of fund. It's typically going to be a multi-cap or flexi-cap. When you look at our portfolio, when we create, you will see the difference. So that's what we are here to tell you, and that's going to be a differential point as far as our portfolio is going to be concerned.
Okay, so not very not much risk per se here. Rohit, yes. Let me come to you now, because we have spoken about high dividend yield companies, how these funds invest in these companies as well. So what do you see as the key attributes of these companies? They are offering high dividend, of course, but as we were mentioning, they are typically known to be PSUs or large caps, but Mr. Singh just said it's not a big concentration here. But is there a concentration risk in that case? Is that something that an investor should be watching out for?
So actually, when we looked at the category and we studied this in terms of, global funds, the equity income category is a large one globally. We looked at the local dividend yield funds as well as Mr. Singh said, the Nifty dividend index. And in that, honestly, we did not find the kind of concentration that one would be worried about, because it was quite diversified across sectors. Now, what comes to mind typically when you're talking of dividend yield fund, generally you're thinking it would be more probably PSU, more probably oil and gas companies or power utilities. We didn't find that to kind of be the case. It was well diversified across various sectors like IT, consumer, even auto, industrials. And of course, you're right. There were the power utilities and energy companies were definitely there, but we didn't find it to be as concentrated as one might think at first glance. And on the second aspect, which is what kind of companies are really there, right? So essentially, these are companies which are more mature in their life cycle. Typically, they're able to pay a steady dividend because that's what essentially the cash flows that they generate from their business, even after their capital expenditure requirements, are such that they can go ahead and use them to pay out regular dividends as well. And there is an element of growth as well. We can talk about that more kind of going forward. But it's not that these companies really don't have growth. We are seeing them across sectors, as I said, and across market cap categories too.
All right, got that. And I'll definitely come back to the growth point. That is something that we want to talk to you about. But Mr. Singh, coming back to you, if you're just talking about this overall category of funds, in the Indian market, it's quite small, right? Around 10,000 crores. What difference do you think it can make in the overall scheme of things? And I know globally this is a big big kind of component of what exists in the mutual fund space. Do you see that kind of potential in the Indian market as well?
Yeah, sure. We are very confident about it, and we'll look at the size. Yes, what you're saying is right. Very, very small category as far as India is concerned. But when we look globally, there's one fund in US which is $50 billion. That is 4 lakh crore fund if we put it the INR. So this is called the equity income category. So, but India, I'm quite sure that this category is going to be very, very big. I foresee that it will be not less than 100,000 crore in very, very short period. Because now the new businesses which are coming, the companies are having very good dividend paying strategies. And we as a fund house also, when the companies are approaching us during the IPOs and all, one of the major filter is what is the dividend paying strategy of that company. And more companies are coming back with this strategies that how much generally they will be giving the dividends. And we have seen very, very even small cap companies giving a yield of 4 to 5%. So that is one. But there's one more point which I really wanted to share with you. See, 2 years ago, the dividends were made taxable in the hands of investors. And whenever any company is giving dividend, so it becomes taxable and even TDS is deducted. But when the dividends are coming to mutual funds, those are mutual funds being the tax, the strategy is such that there's no taxes payable by the mutual funds. So the whole money which comes is reinvested. So is a tax efficient way of getting the dividends. That is number one. And number two, when we are giving when suggesting the cash flows, we are suggesting is through the systematic withdrawal plan, which again is another the tax efficient manner of getting the cash flows, rather than getting dividends from 20-30 companies. Get it from one company, one fund which is having all these companies and have one disciplined cash flow. So we are trying to position it as a solution rather than another diversified kind of fund. And as far as size is concerned, we are pretty sure that this will become a very large category in times to come.
Okay, we take your point, Mr. Singh. Last question for you. I know you have to catch a flight, so we won't take much of your time. But high dividend yield companies usually help limit risk on the downside and perhaps are better placed in uncertain times. Do you think this is a category that may do well now, but could quickly fall out of favor when things normalize?
Yeah, no. See, today when we see we are looking at these are the value stocks or something like that, and but we are sure naturally the companies which are giving regular dividends are the companies we are having a very solid cash flows and which are having the good profitability track record. So these companies we have seen in our back testing also. So these companies fall much lesser than the other companies, and we have seen it for 1 year, 3 year, 5 year, 10 years kind of track record. We have seen that. Out of 10 years, we have seen only 2 years where these companies lost steam little more, less than 0.20% more than the broader market. But in other 8 years, they have created a very, very good alpha over the period of time. So that's something which has given us the full conviction that this is going to be a very good fund, especially for the people who don't want to be very, very aggressive in the equity markets, who want to be little less risky within the equity category. And for the first timers who are joining the equity investment journey, this is going to be the best category. Not this NFO I'm saying, but overall this category is going to be very good, and we are trying to create the portfolio in a very, very unique manner. That's our confidence that we will be able to do very well with this.
All right, I'm glad you said that about the new investors as well, because we get a lot of queries from people who are first-time investors. They're looking to, buy their first mutual funds. So this is a good point to make. But on that note, Rohit and Mr. Singh, we are going to get into a short break now. Rohit, we have lots of questions for you on the other side on how this fund is really built, the kind of companies, and what are the growth prospects. So stay tuned. We'll continue this conversation in just a bit.
Welcome back. You're still tuned into Mutual Fund Corner, and still we have with us Rohit Shimpi to talk about dividend yield funds and the dividend yield strategy as well. Rohit, we spoke a lot about what kind of investments are made, but can you tell us what is the construct of this kind of fund? Where do they invest their money?
Yeah, sure. Thanks. See, the basic, of course, SEBI categorization norm suggests that greater than 65% has to be in dividend yielding companies. Having said that, we went a little further. So we said that the aggregate dividend yield of our portfolio should be at least 50% higher than that of the Nifty 50. And of course, there is potential for other stocks as well. So, there is potential for international stocks, and also REITs and InvITs are one potential opportunity for such a fund.
Okay, and Rohit, I also want to come back to the previous point that you were talking about the growth for these, these stocks. Dividend stocks mainly are value stocks, right? Do you fear on any level that, there may not be sufficient growth prospects here for the chosen companies? Because if they are giving such large dividends, does it in some way mean that they don't have any kind of use for this cash?
Yeah, sure. Thanks. So that's one of my favorite questions, and we've had to, of course, defend that perception from multiple investors and distribution partners over the last few days. So I think, that was our perception too when we started planning out, on the product itself, that there would be limited growth and there would be, fewer number of companies here. But just by virtue of the fact that these portfolios tend to be diversified across sectors, not just limited to, asset-heavy old economy companies which are growing at very slow rates. So because they are across sectors, many of those companies tend to have, potential for a high single-digit growth rate or even a double-digit growth rate in many cases. So, just think about, say, IT companies where we actually found there were cases that companies were growing their dividends at double-digit percentage rates, on a CAGR basis over 5-year, 10-year periods, along with the healthy growth in, in their buybacks as well. And, if you think of, say, even FMCG companies, there's like a high single-digit kind of growth rate potentially out there. So, the way we thought about it is that a good mix for the portfolio would be two types of companies, essentially. The first one is, probably what we all have in mind, the old economy asset-heavy type companies, which are probably growing at, a low single-digit rate. But of course, there one needs to keep in mind that the dividend should be sustainable. You don't want to get into a company where there are corporate governance issues or where, the business itself is unsustainable and you're stuck in a dividend trap, essentially, and you're losing capital in that situation potentially. We think that doing deep bottom-up fundamental research is kind of very important to make sure that the dividend itself is sustainable from the business itself. And the second type of company is where that growth element really comes in. So when you think of a company which is, say, at a more moderate yield, maybe those dividend yields are not, let's say, 4, 5, 6, 7%. They're maybe lower than that, maybe less than 3% dividend yield potentially, but where the dividend is able to grow at a high single-digit percentage rate or a double-digit percentage. We found in many cases that is the element which actually gets you the capital appreciation part of the portfolio. And end of the day, I mean, when you're constructing a strategy like this, the objective is probably not to get, let's say greater than 50% of your total return from dividends. But the thought process is that whatever you do, you're going to have to generate maybe north of 70% of your total return from capital appreciation. So to that extent, growth is important. And in the first case, sustainability of that dividend is very important.
So Rohit, we are not left with much time, but there are some questions that we would like you to answer. There are quite a few dividend yield funds already, right? How will your fund be any different? What is it that stands apart here?
So on a lighter note, when you come in slightly later in the day, you've got the benefit of seeing the track record of those funds. We've got the Nifty Dividend Index, which has been around for over 15 years now. So certainly doing some research on that does help. But I think our thought process in terms of both dividends plus dividend growth is one way of thinking about some differences. Apart from that, I think the part where we need to really figure out whether the dividends are sustainable and in the second type of company growing, that brings us well into an area where SBIMF is very familiar with, which is deep bottom-up fundamental research. Because you know us well, we've got a large team on the ground here working hard, strong investment process on not just bottom-up stock selection, which we think we did really well all these years, but over the last 5 to 7 years, we've added more capabilities on macroeconomics, quant research, ESG, forensics, etc. So I think combination of that and with what we do best traditionally, which is the bottom-up stock selection, is something that can lend a pretty strong perspective to the fund. And essentially, that's something which we're good at in terms of investment management expertise that we have across market cap categories that we can use in the fund too.
All right, Rohit, that's been a very, very interesting chat. And thank you for taking us through, a complete explainer on how this category of funds really works, what is, on offer with your fund as well. But we leave it on that note today. Thank you very much for joining us. And with that, we're going to wind down on this edition of Mutual Fund Corner. You guys stay tuned because closing bell comes up after this short break and they're going to take you through the last hour of trade.